What's happening, future certified public accountants? Pete Olinto with you, but I'm with my crew, my UWorld crew. We got Megan and Keith on the content side. We got Mad on the being mad side, and we got Quinn. Quinn's here to win. So, folks, say hello.
Hello, hello. We will be monitoring the chat here in the background. Ask your questions. We're happy to help. And thanks for being here, everyone.
Sweet, sweet. Uh-oh, did someone take the presenter mode from me? No, I got it. I got it. All right, so welcome aboard, folks. All kidding aside, uh-oh, why do I keep losing my screen? We are very happy you are with us today. So why does this keep switching back on me? It won't stay on that screen. Can you see my screen?
We can see it.
All right, so now hopefully it doesn't switch back. So yes, folks, we are happy you're with us today. We are going to make you masters in the statement of cash flow, heavily tested topic. It makes for a great task-based simulation. If you don't get a task-based simulation on it, you are certainly going to get lots of multiple choice. Someone actually hit us up in the chat room. Why do you got to do all these things for free? We are here to earn your business. Passing or not passing this exam, as you all know, can change the trajectory of the rest of your professional life. And to the extent your professional life impacts your personal life, the happier you are at work, chances are you'll be a better husband, wife, boyfriend, girlfriend, whatever the case may be. So yeah, this is a very important choice. So we certainly want to show you what we're all about. This is actually from our course, our notes, which follow along hand in hand with our textbook. We don't believe in just lecturing to you. It's a lot of back and forth, working practice questions, as well as task-based simulations. So yeah, that's what we're all about, and that's what we're going to do today. So let's jump right in. We always start every topic the same way. We want to show you what the exam is likely to be testing. All right, so we always reprint in the book as well in the slides, hey, these are the tasks you're going to be responsible for. So indirect method, not the direct method. You got to know how to do the indirect method. What you need to know is whether you do operating cash flow directly or indirectly, it's the same result, but you may have to do the indirect method. Anytime you're doing with the indirect method, you're going to start with net income, make your adjustments, and get to your cash flow from operations. Why is that critical? Because an early warning red flag for a company that you might be invested in, accrual basis earnings period after period is going up, but operating cash flow is going in the opposite direction. Then we don't believe in the quality of those earnings, okay? We want to look at the transactions that impact statement of cash flow. We're going to want to correct identified errors. That makes for a great task-based simulation, and that's how we're going to wrap up this lecture on the back end. I will show you how to do a task-based simulation identifying errors. You've got to detect, investigate, and then correct those errors, and that's what we will do on the back end. That's the cliffhanger to get you very excited. So indirect method is what we will also illustrate today. I'm a big believer, folks, as a professional test taker, so as CPA, obviously, I'm a chartered financial analyst, an attorney, passing all these exams. It's definitely not because I have a high IQ. As everyone that I work with can attest to, my IQ is in the left tail, but my work ethic is in the right tail, folks. And that's the difference between succeeding or not succeeding on these exams. The more senses you engage when you study, the more likely it is you're going to retain and understand that information. So it's nice to watch or listen, but at the end of the day, you got to write it. What you write, you will remember. And you also want to speak it. So those senses you engage help to reinforce it here, okay? So I'm going to have you put the pen to the paper today and actually show you how to do the indirect method. We're going to make our own flashcards together. And then we're going to look at transactions that impact the statement of cash flow, how you can get a set of facts and have to determine, hey, is that cash flow from operating, cash flow from investing, cash flow from financing, or maybe none of the above? Maybe cash doesn't go up or down with that transaction, a conversion of debt to equity. No cash in, no cash out. Or maybe you're buying PP&E, but instead of paying cash, you issue a note or you issue stock. So you're going to have to see how to take those transactions and figure out where it goes. All right, what is the purpose behind the statement of cash flow? Explain why cash changed, okay? We want to know why cash changed. So folks, on a comparative balance sheet, you know you're going to have 2 years worth of information. You're going to have last year's ending, which is this year's beginning cash. You will then have your ending cash. So let's say our beginning cash is 10 and our ending cash is 18. Let's say our change in cash is +8. Is that a good sign or a bad sign? Quinn, you are the first contestant on Peter's annoying and calling on me during the lecture. Quinn, cash going up, good sign or bad sign?
Cash going up.
Cash going
Love
up,
it.
I'm sorry. Good sign or bad sign? Cash going
Great
up.
sign. Great sign.
This is why Quinn is in sales, folks. You see what I'm saying? Cash going up. The average person on the street thinks, oh, that's got to be a good sign. Maybe. If you've earned it, I'm very impressed. But what if Quinn gets fired from his job at the end of today's lecture for getting these questions wrong, and now he's unemployed, he's not earning any cash? Well, how's Quinn going to generate cash to pay for his McDonald's and stuff? What does he got to do? He's got to start selling his stocks, his bonds, his house. Cash is coming in, but that's an awful red flag that to pay his operating expenses, he's got to liquidate investments to pay his bills. So the statement of cash flow is going to tell us why cash changed. Where is the cash coming from? I'm very impressed if Quinn is doing a good job and got a big bonus. If he's doing a good job, he's earning it, that's sustainable, all righty? Cash going down, outflows, uses of cash. If cash goes down, is that a bad sign? Maybe not. What if Quinn gets such a big bonus at work and then he takes that cash and he buys a building, he buys stocks, he buys bonds? Although cash is going out the door, what's he buying? Investments, assets that can generate cash in the future, that can generate future rent or interest or dividends. So folks, when it comes to valuation, value is based upon forecasted future cash flow. So when a company is generating or using cash, we want to know where it's coming from. Is it coming from operating? I hope you can generate positive cash from your operations. This looks at your change in working capital. It's really the change in your operating assets and operating liabilities. Operating assets are sort of like current assets. Operating liabilities are sort of like current liabilities. More to come on that. But I hope you could generate cash from your operations. That's sustainable. When it comes to investing activities, this looks at the change in your non-current assets. Now, folks, if your non-current assets are increasing, you're growing. So that means you're opening more stores, you're buying more PP&E. Although cash is going in what direction? Down. When you're on the buy side, increasing the number of stores, the number of factories, although cash is going down in the short term, you're hoping those investments are going to generate sales in the future. Conversely, if you're selling off your non-current assets, if your PP&E is decreasing, you are not growing, folks. You're downsizing. You're closing your stores. You're closing your factories. Although cash is going up, folks, I'm not happy about this because you're not growing and you're liquidating in your investments. If McDonald's starts closing their stores and selling their real estate, even though in the short term, that real estate might be on their books at cost $20–30 million that they bought 70 years ago, that might be worth $300–400 million today. But even though in the short term, they're generating a lot of cash and a big gain when they close that store, how are they going to sell hamburgers and French fries in the future, right, if they're closing their stores? Financing activities. This looks at the change in our own interest-bearing debt, which could be short-term or long-term. The key is it's interest-bearing. I'll talk more about that in a second. And your own equity. So, folks, you're raising capital. I would prefer investing be negative. That means we're on the buy side, we're growing. So if I own the stock, I want to see investing be negative on average. They're growing. Cash flow from financing all depends upon, in the real world, cost of capital. Is it relatively cheap or is it expensive to raise that capital? You see, in the real world, for a company to grow in value, they got to get a return on invested capital greater than their cost of capital. So whether or not financing is positive or negative depends upon the cost of capital and what we call investment opportunities, positive NPV investment opportunities. If they have a lot of growth opportunities, then they should be raising a lot of capital. you want to make money on the spread. If you borrow money at 7% and you can earn 18%, borrow all day, every day at 7%, you'll be adding to your net worth. All righty, so statement of cash flow does what, folks? It's there to explain why cash changed. Cash going up might be a good sign, it might not be. It all depends upon the source and the use of that cash. Not only does it look at the change in cash, folks, but the change in what's called the cash equivalent. Easy multiple choice. What is a cash equivalent? Short-term, fixed income with an original maturity of 90 days or 3 months or less. So it's not going to substantially change in value. Short-term fixed income means it's not an investment in preferred equity or common equity. It's an investment. Think about a CD that's maturing in a month or 2 months or 3 months. All right. So when we look at the change in cash, it's not just cash, but cash equivalents as well. Okay. Anything with an original maturity of 3 months or less. And then there's something called restricted cash. Hey, the company set aside this cash for a specific purpose. They can't just use it on whatever they want. Maybe they're setting aside cash, they're restricting it. I don't know, they've been named as a defendant in a lawsuit. They think they're gonna have to make a big payment. They're restricting this cash. Or they're setting it aside to pay maturing debt, whatever, they're restricting the cash. All righty, statement of cash flows, baby. You ready? We are here to reconcile, and we wanna know, why is it that the cash has changed? And we want to understand, why is what's on your income statement accrual basis different from what's actually happening in terms of the cash coming in and the cash coming out. All right, so folks, we are going to do our cash flow from operating. We're going to actually learn how to do that indirect method, get that number. Could be plus or minus. Cash flow from investing could be plus or minus. Cash flow from financing could be a plus or a minus. That's going to get us change in cash, and this has got to match what is on your comparative balance sheet. We're going to know the change in cash before we even do our statement of cash flow. So long as we have a comparative balance sheet, folks, we're going to know what our change in cash is, but then we have to break it into its 3 components. We're going to take that change in cash. We're then going to add our beginning cash. And what's that going to get us? Our ending cash. Again, the beginning and ending cash is from what? Prior year balance sheet gives you the beginning cash. The current year balance sheet will give us our ending cash. All righty. Now, operating, investing, and financing. Where do we want our operating to be again? We want that to be positive, folks. We want that cash flow from operating to be positive. So, it's not always going to be positive. If you're a publicly traded company and you're reporting your information quarterly, it's not uncommon that certain quarters in the year, your operating cash flow might be negative because you might be a seasonal business and you generate most of your actual cash in certain quarters throughout the year, okay? But on average, I want to see a company's able to generate cash from their core business, selling their inventory, okay? This is their core business. So what we're going to be analyzing is the change in the operating assets, which are all your current assets except the cash and cash equivalents. So things like your accounts receivable, your inventory, your prepaids, maybe certain investments that we call trading securities held for trading, also known as fair value through P&L. And then we're going to look at our change in our operating liabilities, which is the change in our non-interest bearing debt. All right, and I'll talk more about that in a second. That's mostly your current liabilities, but it also includes deferred tax liabilities. That's an operating liability because that's non-interest bearing. All right, so we'll analyze that. Investing again looks at what? The change in your non-current assets. If your non-current assets are going up, you're on the buy side, cash is going down. If non-current assets are going down, you're selling, cash is going up. We're looking at the change really in what? Your PP&E, change in your long-term investments, change in your intangibles, patent, copyright, trademark, franchise, license, things represented by a piece of paper. And then we're going to look at our financing activities, our own debt and equity. Now, folks, when it comes to financing liabilities, how do you know the difference between a financing liability and an operating liability? Financing liabilities, oops, sorry about that, folks. Financing liabilities are interest bearing. Folks, you guys need to know, hey, when you see the word debt, that means it's interest bearing, short term or long term. You see the word note or bond or debenture or a mortgage, MTG, or a line of credit, anything that is interest bearing, short term or long term. I don't care if it's short term or long term. If it's interest bearing, it's a financing liability. All right. And your own equity, folks, not someone else's equity. When you buy or sell equity, is it your own equity? Financing. If it's somebody else's equity, that's a long-term investment. So be careful. When it's your own preferred equity or common equity, that's financing. All righty. When you pay a dividend, but it's got to be a cash dividend, it can't be merely declared. It can't be a stock dividend. It can't be a property dividend. You got to pay an actual cash dividend. That'll be a financing activity. Now, for my international students, folks, you are learning US GAAP for the US CPA exam. Be very careful. You have different options under IFRS. Like IFRS, paying a dividend could be financing or operating, right? Not under US GAAP. US GAAP is very rigid. There's no options. You got to make sure you're converting your knowledge for the CPA exam from IFRS to US GAAP. All right, then there are things that are not on the statement of cash flow. It's a separate disclosure, not on the statement of cash flow. It's called significant non-cash investing and financing. What the hell is that? You buy PP&E, but you do not pay cash. Now, you don't pay cash. Instead, what do? You issue a promissory note. Non-cash investing, you got the PP&E, but financing because you issued a note, or you get PP&E. And instead of paying with cash, now instead we're going to issue our own stock. That is investing and financing. Or maybe you're going to convert debt to equity. When you convert, debt goes down, equity goes up, non-cash. But that's an important disclosure, okay? Those are separate disclosures. All righty, we are kicking ass, baby. Do you feel it? I'm feeling it. I'm feeling it, baby. All right, general rules of thumb, you ready? Anytime an asset goes up, I want you to think about being on the buy side. Absent any other information, cash is going down. If asset's going down, you're thinking I sold it off. Cash is going in what direction? Up. So folks, inverse relationship between the change in the asset and the change in the cash. All right, very different with debt and equity. Whenever liabilities or equity go up, I want you to think about that being a source of cash. We're borrowing or issuing stock. Cash goes up. If liabilities or equity going down, I want you to think about a return of capital. You are paying off that principal. You are buying back that stock. You are paying a cash dividend. Cash goes down. Notice the direct relationship, folks. Direct relationship with debt or equity. When that goes up, cash goes up. When it goes down, cash goes down. All righty. Operating activities focuses in on what? Change in operating assets, which is similar to current assets, and change in your operating liabilities, similar but not exactly current liabilities. Sometimes you'll see that they don't give you current assets or current liabilities. They just give you the change in working capital. What's working capital? Current assets, let's pretend that's 12, minus current liabilities, let's pretend that's 5. What is your working capital? Your working capital is 7. That's really a net current asset. So what's the relationship? When working capital goes up, you're on the buy side of working capital, cash goes down. When working capital goes down, you're on the sell side of that working capital, cash goes up. All righty. So that's another way that we can find our change in our operating activities. What's the operating activities used for in the real world? Value, baby. At the end of the day, if you can't generate cash from your core business, you're going to be out of business. All right. Now, when we look at our operating activities, what we do all day, every day, our core business, where should we get the bulk of our cash from? Customers. All right. Now, my IFRS students, be careful. In US, dividends received from investments, that goes in operating, not investing. We put that in operating. Interest received, that goes in operating. So for my IFRS experts, notice the difference, folks. IFRS, they give you an option, not US GAAP. Dividends received, interest received, that's got to be inflow operating. All righty. Now, when you see trading securities, trading, sometimes called held for trading, sometimes called fair value through P&L. If it's listed as a current asset, it's an operating asset. Okay, it's an operating asset. All right, operating outflows from the core business. We pay our suppliers. Okay, your accounts payable goes down. When your accounts payable goes down, cash is going down. We pay our SG&A, marketing, advertising, rent, insurance, utilities, cash goes down. Interest paid, taxes paid. Again, for my IFRS students, notice the US rule, there's no options there. Interest paid is always an operating outflow, whether you're a bank or not. Taxes paid, I don't care what kind of tax it is, income tax, sales tax, real estate tax, operating outflow, all righty? And then when you buy trading securities, also known as held for trading or fair value through P&L, so long as it's listed as a current asset, it's an operating asset. Now be careful, folks. When you buy or sell non-current assets, things like you buy debt and it's listed as held to maturity, or what they call today amortized cost, that's investing. All righty. When you buy securities classified as available for sale, or what they call fair value through OCI, that's also investing. When you buy or sell anything that's listed as a non-current asset, that's an investing activity. All righty, that is investing. Why am I screaming at you guys? I have one volume, loud. I'm excited. Are you excited? Matt, are you still excited? Tell me, Matt, are you still excited?
Pete, I'm always excited.
Let's go. That's what I'm talking about. Megan and Keith, my colleagues at UWorld. You want to talk about a team, baby? We got teachers from UWorld, from Roger. We've got teachers that came over with Wiley, and I came over from some course I can't remember the name of, man. We got a team, a monopoly. Keith and Megan, say hello.
Hi.
Hey, what's going on, guys?
All right, man. These are the best of the best, folks. Megan, Roger, and I were just in Megan's. We just broke into her video studio the other day. Sorry about that, Megan. We couldn't help ourselves. We both have ADHD, so we had to interrupt. All right.
I love having visitors. Welcome it.
Thank you. That's cool. That's cool. I love it. We had a lot of fun. Yes, we did. So, yeah, operating activities. Ready? IFRS versus US GAAP. What's the US rule? Interest paid, interest received, dividends received. Under US GAAP, that's always operating. All right, that is always operating, where you're paying the interest, receiving the interest, or dividends received. Under US GAAP, read carefully. Don't jump on the word dividend. If it's paid and it's cash, that's going to be a financing outflow. If the dividend is merely declared, or it's a property dividend, or a stock dividend, that is not on the statement of cash flow, because there's no cash in, there's no cash out. All righty. So dividends paid, financing outflow under US GAAP. Okay, I know under IFRS you have an option, not under US GAAP, financing outflow. Okay, our investing activities. In the real world, what are financial analysts looking for? The change in non-current assets. There's a signaling effect in the real world. What's the signaling effect? If they're on the buy side, they are growing. Assets up, although cash is down. What are we forecasting? Greater future cash flow. Now, we can't guarantee that more stores will equate to more profit, but there's a high correlation between the number of stores, the number of factories, your capacity to produce, and sales revenue. That's a good sign. And as a general rule of thumb, the higher the company's growth rate, the higher their value. On the flip side, if they're selling off their non-current assets, they're downsizing. Assets are going down. Their non-current assets are going down, folks. Although cash is going up, they are not growing, they're downsizing. And as a general rule of thumb, the less stores, the less factories, the lower the sales, the lower the what? Value. All right, so that's why we're looking at our investing activities. Okay, so our investing activities, what's this lip all about? Well, the change in our non-current assets, be on the lookout for 3 different types of transactions. Loans that you make, okay, where you are the lender, not the borrower, the lender. If you're the borrower, it's financing, okay? We're talking about being the lender. So loans, the I is going to stand for 2 things, whether it be investments or intangibles, whether you're on the buy side or the sell side. Look for long-term investments and intangibles. That's an investing activity. And then change in your PP&E, yeah, you know me, your lip. All righty, those are going to be our change in non-current assets. So inflows and outflows, okay? So loans made to other entities, okay? You're the lender, not the borrower. When you're the lender, it's an investing activity. When you're the borrower, it's a financing activity. All righty, so be very careful with the lending. All right, now interest and dividends received are always going to be operating under US GAAP. So we're talking about the principal. All right, when you make a loan, you give a loan, that's going to be an investing outflow. The principal is going to be an investing outflow. When they repay it, the principal's an investing inflow. But distinguish between the principal and the interest, folks. The interest received is going to be what? Operating. But the principal received, that will be investing. All right. When it comes to investments, folks, if they're classified as a current asset, that's going to be operating. So long as it's classified as non-current asset, then it's going to be investing. When you're on the buy side, cash goes down as the asset goes up. When you're on the sell side, cash goes up and that asset goes down. But be mindful, is it current asset or a non-current asset, okay? And then your PP&E, as well as your intangibles. Your PP&E, intangibles, things represented by a piece of paper, franchise, license, patent, copyright, trademark, whatever it is. All right, all those items there are going to be investing. Okay, now be careful with major repairs. When you capitalize the repair, that is considered investing. All right, that'll be an investing outflow, a major repair, as opposed to ordinary. Folks, ordinary repairs and maintenance, that'll be an operating outflow. All right, but if it increases the useful life, if it's a major repair or addition and we capitalize it, then it's an investing outflow. Okay, now a question, folks. This is what I love about UWorld. Instead of lecturing on forever and not practicing it, nah, it's a back and forth. There's no just talking about, oh, let's just talk about the concept. What the hell is that about? You got to show me. We got to practice it. Before you go and try questions on your own, we want to practice it together, both multiple choice and task-based simulation. So here we go. We purchased a copier. As soon as I see that, PP&E, we're on the buy side. PP&E up, cash is going to go down. How much did we pay? Costing $40,000. Now, how much did we actually pay with cash? $23,000 down payment. That's going to be an investing outflow. Cash is going down by $23,000. And then the note payable for the balance, that's non-cash investing because PP&E went up, and financing, we borrowed. liabilities go up. And that'll be for the balance 40 minus 23, $17,000. The 40 minus the 23. All right, purchase of available for sale securities. So long as it's not held for trading, the presumption is when it's available for sale, or what they call fair value through OCI, unless they tell you otherwise, non-current asset, $100,000. So non-current assets up, that will be an investing outflow, Issuance of a long-term, we're making the loan. So folks, we're the lender. Be careful. If we're the borrower, it's financing. We're the lender. We're lending out $5,000. That is an investing outflow. Note receivable is going to go up. That's an investing outflow. All right, as the note receivable goes up, cash is going down. Okay, now they tell me during the same year, we sold the copier, we sold PP&E. That's going to go down, cash is going to go up. That we purchased earlier in the year for $36,000. It had incurred $8,000 worth of depreciation. Okay, so we sold it for $36,000. You ready? One step at a time. So that's going to be a cash inflow investing. Cash inflow investing. Our selling price, $36,000. That will be an investing inflow. What was our net book value at the time of sale? What did that cost us? 40. Your cost minus your accumulated depreciation. Cost 40. How much depreciation? 8. 40 minus 8, net book value 32. That'll be a gain of $4,000. That's the copier. Notice, you read it piecemeal. As you read it, you process it. You can't read it casually, passively. You got to read it actively. As you read it, process it. Okay, then we turned around and sold the available for sale debt security purchased earlier in the year for $80,000. We sold an investment. PP&E is going down, cash is going up. All right, so here's our available for sale security. Our selling price, dropping the zeros, 80. Now they tell us, let's see, we purchased that available for sale security for how much? Oops, somebody screwed up. Our cost was 100,000. That's our carrying value, 100. Well, we got a loss of 20. The selling price, the proceeds on sale, that's an investing inflow. What do you do with the gain or loss? The gain or loss is an adjustment to net income when you do cash flow from operations under the indirect method. All righty. Finally, Arlington received a payment of $2,100 on its long-term loan. That $2,100 payment consisted of $100 under US GAAP. Where does the interest go? That is cash inflow. What category? Operating. And then they got $2,000 principal repayment. That's a cash inflow. What? Investing. You read it actively, folks. Now, this could be a task-based simulation because they could easily ask, 3, 4, 5 questions from this. Or this could be 3, 4, or 5 individual multiple choice, and they could ask any piece of the puzzle, but we got you covered. All righty, journal entries, you bet. When you buy a copier, that's PP&E. When your PP&E goes up, cash is going in what direction? Down. That purchase price, the down payment, not the cost, folks, not the $40,000 cost, just the cash portion. That was an investing outflow. There's your journal entry. The note payable is disclosed where? Non-cash, financing, investing. Where did they get that from? The 40 minus the 23. There's your plug figure. The sale of the copier, when you sell it, your PP&E goes down, but our cash goes up. This is cash received, our selling price, investing inflow. That's our selling price of 36. How do we get rid of accumulated depreciation? With a debit. It's a contra asset. All righty. How do we get rid of PP&E? With a credit, 40. Gain on sale is our plug figure. Your selling price minus your net book value is your gain or loss. How do you get your net book value? Cost minus accumulated depreciation. Selling price 36. We had a cost of 40, accumulated depreciation of 8. 40 minus 8, 32. We have a gain of a +4. All righty. Beautiful. Beautiful. All righty. Investment transactions. Remember, if it's a current asset, a trading security held for trading, fair value through P&L, that's operating. If it's a non-current asset and absent any other information, whether they call it available for sale or fair value through OCI, if they call it held to maturity or amortized cost, absent any other information, that is an investing activity. It's a word association game. You got to read actively. All right. When I see available for sale, I think investing activity. All righty. That long-term investment goes up. Cash is going in what direction? Down. Investing outflow for my purchase price. When we sell it, now my long-term investment goes down, opposite direction. Cash goes up. 80, cash inflow investing. All righty. Loss on sale is your plug figure. Our carrying value at the time of the sale, it had not changed. They did not mark it to market value. It did not change till 100. We've got a loss of 20. Okay. A loan, folks, remember, when you're the lender, the principal, investing activity. When you're the borrower, the principal portion of the loan, financing. In our example, we were the lender. So the loan, the note receivable goes up. Note receivable goes up. Cash went in what direction? Down. Investing outflow. Partial repayment, the principal only. The note receivable goes down. As I say down and I write an up arrow, the note receivable goes down, cash goes up. Now be careful, folks, the cash, we got to segregate between principal and interest. The principal portion, okay, the principal portion was 2,000. So the 2,000, that's investing inflow. The 100, the interest is what? Operating inflow. So the common mistake is to take the whole 2,100. When somebody repays a loan to us, the interest portion is what? Operating. And under US GAAP, interest is always operating, whether you receive it or pay it. The interest portion, whether you're paying the interest or receiving it, is always operating under US GAAP, not true under IFRS. And here it is, folks, our LIP. Now all we did was take everything and put it in its right order, okay? And there's no particular order here. I'm just saying all of our, we're just summarizing all the information. So the PP&E transactions, we bought it, we sold it. Remember, when you buy it, it's an outflow. When you sell it, it's an inflow. The securities, the long-term investments, when you buy it, outflow. When you sell it, inflow. Just watch your signs. And then your loans. Just make sure you're on the lender side if it's investing, not the borrower. Okay, so when you make the loan, outflow, when the money comes back to you, just the principal. And what's our acronym? Don't give me any lip, baby. Don't give me any lip. All right, we are kicking ass, baby. Do you feel it? I'm feeling it. Let's go. Financing activities, you ready? What are our financing activities? Change in our own debt and equity. Now be very careful. Liabilities, there are two types. Operating liabilities, which are mostly your current liabilities, most current liabilities, and your deferred tax liabilities. Those are your operating liabilities. Your financing liabilities are anything that's interest bearing. The more times you write it, you hear it, you read it, you will remember it. Look for the word note, bond, debt, debenture, a mortgage, a line of credit. Now, the financing liabilities could be a current liability or long-term. They're usually long-term, but they don't have to be. Okay, they don't have to be. Okay, when it comes to equity, If it's a different company, that's investing. If it's your own common equity or preferred equity, that's financing. When liabilities or equity goes up, you're raising capital. Cash goes up. When liabilities or equity goes down, you're returning that capital. Cash goes down. Direct relationship. Okay. Everybody with me? Megan, is my New York accent, is it understandable? I'm working on it. I'm trying not to sound so New York. How am I doing?
I think so. I think so. I think you sound less New York today. But I
Beautiful.
lived in New York, so I'm used to it. My ears tuned to that.
How many times did you get mugged while you were in New York?
Not once.
Come on.
0 times.
All right, next time you come in, we'll see what we can do about that. Make sure you have some
Fantastic.
plastic
Sounds like an adventure.
Come on, man. You know I'm only serious. All right, here we go. Ready? Financing activities, you don't have to memorize. You know the deal. If it's related to debt, your own debt, you're on the borrower side. That's going to be financing. All right. So when you issue the bond, inflow. When you retire the bond, you pay it off, outflow. Proceeds from borrowing, inflow. Principal, not interest. Principal, outflow. When you repay the interest, where is that going? Operating. All righty. When you repay the interest, that is operating. Our own equity, not another company, our own equity. You issue the stock, inflow. You reacquire the stock. What do we call our own stock when we buy it back? Treasury stock. When treasury stock goes up, cash goes in what direction? When we buy our own stock back, we're buying our own stock back. Treasury stock is contra equity. So be careful. This one is unusual. It's unusual. When you repurchase your own stock, all righty, treasury stock goes up. When treasury stock goes up, cash goes down. Cash dividends, it's got to be paid, folks. It's got to be paid. How do I know? How do I know if the dividend declared was paid? How do you know if a declared dividend is paid? You go to your balance sheet. You've got your beginning dividends payable. Where do you get your beginning dividends payable? Last year's balance sheet. Last year's ending is this year's beginning. Add the current year amount declared. That gets you the total due the stockholders. And then either you paid it or it's in your ending dividend payable. Where do you get your ending dividend payable? Current year balance sheet. Paid is your plug figure. All righty. And how do you know if a dividend is declared? Beginning retained earnings. Let's say that's 10 plus your current year profit. Let's say that's 2. We get a subtotal, 12. Let's say my ending retained earnings is only 7. Then what the hell happened to the other 5? Therein lies your dividend declared. It must be 5. Okay, your beginning retained earnings plus your current year profit, we get a subtotal, 12. If that doesn't equal your ending retained earnings, you must have declared a dividend. So let's say my beginning dividend payable is 8. We declared a dividend of 5. What's the total due? 13. I find my ending dividend payable is only 2. That means I must have paid how much? 11. And whoop, there it is. Now, don't jump on the word dividend. I don't know if the dividend is financing or operating, because when the dividend is paid, yeah, that's a financing outflow. But if the dividend is received, that's operating inflow. All right, so don't jump on the word dividend. You got to tell me, did we receive it or did we pay it? Okay, that's going to be the key. All righty. Question now. Love the questions. Here we go. Task-based simulation, multiple choice. Let's see what we got. Wrightwood Company engaged in the following transactions. They issued 80,000 shares of their own stock for 800,000. That is a financing inflow. Now, specifically, the par value is 250. So, folks, your stated capital is going to go up by 80,000 shares times the par value of 250. That's going to be $200,000. Your stated capital goes up. Where did the rest go? Your paid-in capital, the excess. Okay, how much is the excess going into additional paid-in capital in excess of par? 800 minus 200, that's 600,000. Okay, some of it goes into stated capital, the rest goes into additional paid-in capital. But either way, financing inflow, cash went up by 800,000. Issuance of a bond, we are the borrower. It's a bond, financing liability, financing inflow. During the year, we paid 100,000 for the repurchase of our own stock. Treasury stock up, cash down. How much did we pay for that stock? $220,000, okay? 100,000 on the stock we repurchased. Then they tell me we paid 220 on the bond. The principal repaid 200, financing outflow. The interest paid, the 20, operating outflow. And again, no options under US GAAP. All righty. So there's the change in our own debt and equity. When you issue stock, paid in capital up. Whenever equity goes up, cash goes in what direction? Up, financing inflow. And then we segregate between the par value and the excess, which is our plug figure. Repurchase of our own stock. Paid in capital goes down anytime treasury stock goes up. Cash is going down. Financing outflow. Remember, treasury stock, contra equity. Treasury stock is a contra account. All righty. Treasury stock up, equity down. Equity down, cash down. We're repurchasing our own stock. Repo our own, not somebody else's stock, because if it was somebody else's stock, it would be what? Investing. All righty. Debt transactions. Debt up, cash up. We are the issuer of the bond. We're the borrower. We know the deal. When we're the lender, that's an investing activity. When we're the borrower, excuse me, that's going to be a financing activity. Financing inflow. And folks, notice, you ready? The issuance of the bond, it was issued at what? At par. Anytime the proceeds, the selling price of the bond, if that equals the face value, there's no discount, there's no premium. All righty, more to come on that in a second. When you repay the bond, you got to be careful. Okay, as debt goes down, the principal goes down, cash goes down. All righty, so the bond payable principal, that's going to be what? Financing outflow. The interest paid, that's going to be operating outflows. So you got to segregate the cash paid between principal, financing, and interest operating. Okay, now be careful as well with the interest. Interest expense is not the same thing as a coupon paid. Interest expense goes on the income statement. Coupon paid is what goes on the statement of cash flow. How do you know? How do you know if the interest is paid? How do you know if the interest is paid? You look at your beginning interest payable. Where do you get your beginning interest payable? Last year's balance sheet. Last year's balance sheet. Plus your current year interest expense. Where do you get your current year interest expense from? Your current year income statement. That's the total amount that is due. And then one of two things happens. What's in your ending interest payable. Let's say the beginning interest payable was 5. Let's say the current year interest expense is 20. What's the total amount due? 25. Let's say your ending interest payable is 18. Then that means we must have paid how much? 7. 25 minus the 18. All righty, so we always got to be careful. Interest expense is not the same thing as the coupon paid. We're looking for the coupon paid. All righty, and here it is, cash flow from financing. Change in our own debt and equity. Cash proceeds, sale of stock, inflow. Cash paid to buy treasury stock, up. Equity down, cash down, outflow. Proceeds from the issuance of a bond, inflow. Repaying the principal only, outflow. What's the net cash provided by financing? $1.5 million. All righty. Now, very important. I know this is not a bond class. All righty. But let's say the selling price of the bond, you issue it for $1.1 million, greater than the face value of $1 million. Folks, that's really a gain, but we can't call it a gain. We call it a premium. We call it a premium. When your selling price is greater than the face value, for our purposes in the statement of cash flow, I want you to think about a gain. If the selling price of that bond, we issue it for $970, less than the face value of $1,000. Well, folks, that's really a loss. That sucks. You got to repay $1,000, but you only got $970. So anytime a bond is issued at a discount, which is really a loss, we know our selling price is less than our face value. All right, so think of the word when you issue a bond. I'm not talking about being the lender, okay? I'm talking about being the borrower. We're on the borrowing side, okay? When you're the borrower and you issue a bond at a premium, that's good news. You received more than the face value. Think of the word gain, okay? Premium, gain. Whenever you issue a bond and collect less than face value, a discount is really a loss. Now, how come we don't, when we account for bonds, why don't we just immediately book it as a gain or a loss? That would violate the matching principle. Now, we're not covering bonds here, but we can't immediately book. Like if I sell the bond for $1.1 million and I only have to repay $1,000, why don't I just debit cash for $1.1 million, credit my note payable, my bond payable for $1,000, and immediately put $100 into equity as a gain? Put that on the income statement. Violates the matching principle. So instead of booking that premium or discount immediately, we amortize it over the life of a bond. All righty. So when you amortize a premium, your interest expense will actually be less than the coupon paid. Or when you amortize a discount, bad news, your interest expense will be greater than the coupon paid. Insofar as the statement of cash flow goes, though, when we do our statement of cash flow indirect method, I want you to think when you're amortizing a premium, hey, that's a gain. We're really amortizing. But when you amortize a discount, that's really a loss. You'll see why that's important in a little bit. Cliffhanger to keep you excited. All righty, indirect method. You ready? Statement of cash flow. In reality, same result, different format. You get the exact same result whether you do the direct method or the indirect. Now, the AICPA has said the only method you're responsible for is the indirect method. All righty, indirect method. But you need to know in theory under US GAAP, you could do either one. But when you do the indirect method, you'll get the same result as the direct method. The indirect method is really a reconciliation of net income to cash flow from operations. Why is there a difference? So you ready? Get a piece of paper, write it with me. What you write, you will remember. So don't just watch me on the treadmill. That ain't gonna help you lose weight. Get on the treadmill with me. You ready? Let's make our flashcard. From here on in, you're going to know this inside and out. You're going to take your net income. You're going to add back most depreciation and amortization. Why do we add that back? Because it makes your net income go down, but no cash went out the door. Okay, most depreciation and amortization. You're going to add back losses. Why are you going to add back losses? Because a loss by definition is non-operating, not part of your core business. Anytime you have a gain or a loss, that's from an unusual or infrequent activity. So that's not part of your core business. We add back a loss, made your net income go down, but no cash went out the door. Okay, you're going to subtract gains and amortization of a bond premium, because we just said a bond premium is really what? A gain. All right, so any gains, non-operating, not part of your core business, makes net income go up and not part of your core business. All righty, an amortization of a bond premium, although you see the word amortization, because it's a premium, you think, oh yeah, that's a gain, we're going to subtract that out. Equity earnings in excess of cash received. Any equity earnings from an equity affiliate greater than the cash received, hey, that makes your net income go up, but you don't have the cash. So any equity earnings in excess of cash received. All righty. Then, you ready? You're going to subtract your change in all operating assets, inverse relationship between assets and change in cash. The negative sign means just do the opposite. If an operating asset goes up, subtract it. If it goes down, add it. The negative sign means do the opposite. Direct. You're going to add the change in any operating liabilities, because when liabilities go up, cash goes up. When liabilities go down, you're repaying it, cash goes down. Therein lies your cash flow from operations, okay? Now, I just want to point out one thing with losses. There are multiple ways to express this, all right? So, like bad debt expense, it's an expected credit loss, but it's called bad debt expense sometimes, or warranty expense. Oh, that sucks. We got to fix this car. Yeah, we got to accrue for that. When you accrue for warranties, bad debts, folks, those are really losses, all righty? Really losses, but we can't call it a loss. Matching principle, right? We have to make sure we record it in the same year we sold the car, right, to match the warranty. Bad debt expense, someone's not going to pay you in the future. Well, we can't wait to book that loss. We got to book it now in the same period we lent the money, all righty? So be careful with losses, whether they call it expected credit loss or bad debt expense, warranty expense. All of those things have to be added back because we're booking an expense, but no cash went out the door. All righty. So let's bang it out. You ready? Nice and neat now. Check it out, folks. But see, what you write, you will remember. So here is your date. Very important. Put down date for Friday night. Whatever you're going to do, cancel those plans. You're going to probably be destroying brain cells or wasting your time on a date. Forget that date. All right. Don't be on Tinder, because that'll only hinder your performance. You have no boyfriend, girlfriend. You have no, I am your significant other. Until you pass the exam, nobody likes you but me anyway, because all you ever do is study, right? Oh, you ever do study, you're a boring account. Let them go out and find somebody else. If your boyfriend, girlfriend, husband, wife, whoever it is giving you a hard time saying all you ever do is study, let them go. They're doing you a favor, because after you pass the exam, your value's going way up. Chances are you're going to find somebody better for you anyway. So get rid of them now, especially before you get married, because if CPA, that's a license. If you get that during marriage, that's marital property. It's like buying a house. They'll get half your license. Don't give nobody half your license. Don't get married until you already have your license. Then it's your separate property. You know, I have issues, folks. I was dating a girl when I was your age, studying for these. Oh, you're bored. What she ever did? She always gave me a hard time. I was going to the library. I said, do you think on Friday I want to go study pensions? Is that what you think I want to do? Because I'm hoping on the drive over to the library, my appendix bursts so I could go to the emergency room instead. It's not what we want to do. It's what we have to do, but for a short period of time. All righty. So net income, folks, you're going to find that per your income statement. We want to reconcile that with the cash provided by our operating activities from our core business. All righty, so the goal is to assess the quality of these earnings. You know, when you have high quality earnings, when we see a correlation, yeah, we're accruing for it and I'm getting the cash. When they're generally growing and moving in the same direction. Now, there's a timing difference between cash basis and accrual basis. I get it. But as a general rule of thumb, if your earnings are growing by 12%, you know, your operating cash flow should be growing by a similar amount. The red flag is when your earnings are growing by 12, but your operating cash flow is going down period after period. I don't believe you. All right, so we take our net income, we add back our depreciation, we add back our amortization, we add back our losses. Losses, sometimes we'll call it a write-down of an asset. That's a loss, or a write-off, or it's a bad debt, or it's a warranty. We accrued for an expense, but no cash went out the door. All righty. We're going to subtract equity earnings in excess of the actual cash received. The amortization of a bond premium, because that's a gain. Any other gains, non-operating. All righty. Change in operating assets, inverse relationship. Change in operating assets. Any operating asset, if it goes up, we're going to subtract it. If it goes down, we're going to add it. Change in operating liabilities, direct relationship. If that liability goes up, add it. If it goes down, subtract it. And whoop, you're done, baby. So there it is. Our goal is to understand why net income per the income statement. Why is that different from cash flow from operations? Why is that different from cash flow from operations? Is this number believable? Is it believable? When is it not likely to be believable? When your net income period after period is going up, but I don't see any cash being generated, something don't seem right. It doesn't make sense. All righty. So we want to go from our cash basis. We want to go from cash basis, or I should say we want to go from accrual basis to cash basis, and we want to go from net income, which includes all operating and non-operating activities. We want to go from net income to just the operating, the core business. That's why we back out gains and losses. That's why we back out gains and losses. Gains, we're going to subtract. Losses, we'll add back. Okay, so we want to go from accrual basis to cash basis. We want to go from all activity, all revenues, expenses, gains, and losses to just the core business, okay? So we're going to make our adjustments. Just make sure, folks, liabilities, two types. Operating liabilities is what we're focusing in on. Financing liabilities, remember, that could be short-term or long-term. Is it interest-bearing debt? If it's interest-bearing debt, even though it might be short-term, that's financing. Operating liabilities, don't forget, that includes deferred tax liabilities, because deferred tax liabilities is not an interest-bearing liability. You don't pay interest on that. All righty. So investing and financing, folks, are not affected by direct or indirect method. Direct or indirect method only affects how we present the cash flow. The direct method starts with cash collected for customers, and then you've got all your cash paid for your operating expenses, and that's how you get your cash flow from operations. Indirect method starts with your net income per your income statement, then we make income statement adjustments, balance sheet adjustments, same result, just a different format. Same result, just a different format. What's the only thing we're responsible for on the exam? Indirect method, in terms of doing the details. Okay, net income per your income statement, then we'll make certain adjustments to income statement items. Oh, whoa. Sorry about that. We'll make certain adjustments to our income statement items, and then certain adjustments to our balance sheet items. All righty. Sorry about that. My big hand screwed that up. Let's see. There we go. So let's practice it. Here we go. You ready? We got net income of $140,000. That is your starting point, indirect method. That is your starting point when you do the indirect method. All righty. So this 140 is per the current year income statement. If they give you 2 years worth of income statement, folks, make sure you're looking at the current year. Now, what adjustments am I going to need to make? The depreciation expense of $50,000, I'm going to have to add that back. Why? Made net income go down, but no cash went out the door. Credit any loss, bad debts, warranties, okay, any loss, sale of PP&E, I got to add that back. Made net income go down, but it's not part of my core business. All righty. A gain, when I see the word gain, what do I think? I got to subtract that out. Why? That made net income go up, but it's not part of my core business. Amortization of a discount. I told you, when you see discount, what do you think? Hey, that's a loss. It's a big loss. We don't have a lot of discos out there anymore. How am I supposed to go dancing with no disco? Well, that's a loss. That's a big loss for me. So what do we do with losses? Losses we add back. Made net income go down, but it's not part of our core business. We add that back. So those are our quote unquote income statement adjustments, okay? Let's see what else we got. Now we've got balance sheet information. This is comparative. Comparative. Prior year amount versus current year. Okay, here are the changes. Accounts receivable and inventory, that is a change. We subtract the change in the operating asset. We do the opposite. So if accounts receivable went up by 80, I'm going to subtract 80. Inventory increased by 30. Inventory up, I'm going to subtract that 30. Accounts payable, taxes payable, non-interest bearing, I'm going to add the change in operating liabilities, keep the sign. Decrease by 20. Accounts payable down, I'm going to subtract that 20. Taxes payable increased by 40. Taxes payable up, I'm going to add that 40. Change in operating assets, do the opposite. Do the opposite. Change in operating liabilities, keep the sign. Keep the sign. Direct relationship, okay? Now there's your balance sheet. Now all we got to do is put the pieces of the puzzle together, okay? We know these are our income statement adjustments, the income statement adjustments. We've already labeled all this. Depreciation, we're going to add back. Discount is really what? A loss. The little piece of the loss this year, we're going to add that back. Credit loss, we add back. Gain, we subtract out. Piece of cake, baby. Keep piece of cake. All right, they want journal entries? No problem. You ready? Balance sheet adjustments. Balance sheet adjustments. Folks, when accounts receivable goes up, no cash yet. When accounts receivable goes up, that means we accrued for the revenue. When you accrue for it, you don't have the cash. So when you don't have the cash, when accounts receivable goes up, what do? Subtract. We subtract the change in operating assets. Accounts receivable, inventory, prepaids, trading securities, we do the opposite. All right, accounts receivable up, we're going to subtract that. Inventory increased. Inventory is up. All righty, when inventory goes up, we're on the buy side. Cash is going down. All righty, when cash goes down, what are we going to do? Inventory up. We subtract. Operating asset up. We do the opposite. You subtract. All righty. Accounts payable decrease by 20. When any liability goes down, you're paying it off. Okay, accounts payable, that's an operating liability. Accounts payable down, cash down. Keep the sign. Operating liability down, cash down. Direct relationship with the operating liabilities. Keep the sign. Income tax expense. You ready? We accrued for the expense. There's no cash paid yet. So when you accrue for an expense, that means no cash paid yet, just like accrued revenue means no cash received yet. All righty. So an operating liability just went up. When an operating liability goes up, taxes payable, what do? Keep the sign. Keep the sign. If it goes up, if it increases, add it. We keep the sign. Okay, no problem. And here it is, man, nice and pretty. Nice and pretty for you. All right, folks, this is heavily tested. It makes for a great task-based simulation. All righty, this is now just putting the pieces of the puzzle together. While our net income per the income statement was 140, the cash provided by operating is only 115. Now, is that a big deal in and of itself? No. But if period after period, we keep seeing positive net income greater than your cash flow from operations, as an auditor, you know what? You got to start looking into that accrual basis net income. All right. So, you ready? Net income. Here are income statement adjustments. All of these are income statement adjustments. We add back depreciation. A discount is a loss. We add it back. A loss, add it back. Gain, subtract it out. Here are all our balance sheet adjustments. Change in operating assets, we do the opposite. You subtract, do the opposite. Increase in accounts receivable, we subtract. Increase in inventory, we subtract. Change in our operating liabilities, you add the change in the operating. The plus sign means keep the sign. Decrease in accounts payable, subtract it. Increase in taxes payable, add it. And whoop, there it is. Woo, baby. I feel like I'm giving birth to a CPA. All right, statement of cash flows, the whole thing. You ready? We've got our cash from our operating. Hopefully that's positive. Not always, but the majority of the time, a mature company, as a general rule, better be able to generate cash from the core business or we got a problem. Investing, if it's negative, cash is going down, you're on the buy side, but you're growing. That's good. If it's positive, cash is going up, you're selling, you're downsizing. Although cash is going up, that could be an early warning red flag of fraud. Companies that cannot generate cash from their core business, they start doing messed up things like selling off PP&E or investments and trying to call that, inventory, selling inventory, trying to make it look like the core business. All righty. So folks, when you can't generate cash from your core business, companies start liquidating investments. And if a company is liquidating investments, if that's going down, it's like you getting fired from your job. You got to eat. If you don't have a salary, how are you going to eat? You have to start selling your stocks, your bonds, or real estate. Now, occasionally, it might be a good time to sell it. But if they don't ever replace it, how are they going to stay in business, right? So if period after period, they're liquidating those investments, not a good sign. And then cash flow from financing, that could be positive or negative, depending upon what? Cost of capital. That is dependent upon, number one, is it expensive or cheap, cost of capital, and growth opportunities. Oftentimes, companies with a lot of growth opportunities, what we call positive NPV investments, IRR, greater than their weighted average cost of capital. When companies have a lot of growth opportunities, they're going to be raising a lot more capital because they confidently believe they can reinvest these funds and earn a positive spread. Okay, your net increase or decrease in cash, your beginning cash, this all comes from your comparative balance sheet, a comparative balance sheet. All righty. So you're going to know your change in cash before you even do your statement of cash flow because you'll have that per your comparative balance sheet. All right. Now, task-based simulation, baby. So we've shown you how this can be tested in a variety of multiple choice. The question becomes, what about task-based simulations? How does this make for a good task-based simulation? But before I do that, I want to ask my friends, Megan, Keith, Quinn, and Mad. Any questions for me, like high level? Like, have you seen like a trend in questions where people, maybe you think I should address something here before I do this TBS?
Hey, Pete, we do have some questions that have come in so far. If you want to pause and take a couple.
Yeah. I'll take a couple. Let's go.
Tell
me what you got.
This was a good one that I think is for good for the greater audience. Let's see. Within my study plan, it incorporates the task-based simulations after each multiple choice set. I know he says, to focus on the multiple choice questions before attempting the task-based simulations. Do you recommend going into the Q bank and just working through MCQs after going through the MCQs in the study plan before moving to the task-based simulations in each section?
As a general rule, yes. Unless you feel like that topic is your area of expertise, in which case, then the general rule doesn't apply. But the general rule is, folks, task-based simulations can be very challenging, as I always say, even if it were open book, because just the mountain of information that's thrown at you that you have to process, if you don't already know those rules, like here, if you don't already know what's operating, investing, and financing, if you're still wishy-washy on how to do the indirect method, You'll be blown away by a task-based simulation. You're going to waste a lot of valuable study time spinning your wheels because you're not ready for it yet, right? So before you run I don't know, how long is the New York Marathon? I'm going to make it up 40 miles. I have no idea. You think I'm going to run a marathon? I can't run around the block. So where was I going with this? Yeah, before you run like the New York Marathon, you might want to do one of those like 3K things or 5K things, right? So you got to gradually progress. That's the highest level of application. So before you get to the task-based simulations, you don't want to waste your valuable study time spinning your wheels. Master the concept by banging out your multiple choice first and say, okay, now I'm ready to handle this mountain of information like we're about to do here.
Great. And I'm pretty sure all marathons are 26.2 miles, but that's just, I'm pretty sure they all have a standard.
You think I'm running a marathon? You know what I had last night? I had 2 cheese calzones. I literally put on about 14 pounds last night. If I try to run a marathon, forget it. All right, Gad, I'm sorry.
So is the direct method of cash flows still tested on the CPA exam?
No. So the only thing you're responsible for in terms of actually crunching the numbers is the indirect method. You need to know the direct method exists. You need to know that, hey, that shows you exactly where you're getting your cash from, customers, like I showed you, minus the cash you're paying for your operating expenses, but they don't expect you to crunch those numbers. But you do need to crunch the numbers for the indirect method. So know it exists. Know whether you do direct or indirect, you're going to get the same result for operating cash flow. But what's going to be testable is indirect method in detail. And that's what I'll show you here.
Great. Okay, we have a couple more, but why don't you get into this and we'll save those for the end.
All right, here we go. I can't do my TBS without my headband, baby. You ready? CPA man is making an appearance. Let's bang it out. Whenever I do my task-based simulations, I got to be ready to go. So let's do it, baby. Here we go. Ready? We got errors, man. So in this task-based simulation, what do we got to do? I know the rules so well that I can identify what they did wrong, okay? And then we're going to have to detect, investigate, correct the discrepancies. Not only do you have to identify the error, which is cool, but then how do you fix somebody else's error? What are the adjusting entries, right? So that's what we'll be doing now. So we've got a controller, and the controller has reviewed a draft statement of cash flow and believes it has several errors. Okay, I got to identify the errors. Using the exhibits and information, additional information, stop right there. Folks, step number 1, when you do a task-based simulation, I call it legalized cheating. What do we always look at first? The questions. What is it that they want me to do with this mountain of information? Because they love to give you distractor information that has no bearing on that solution. But so before you get bogged down in all the exhibits and additional information, scan what the questions are, and then you'll know what to do with the facts, because now you're reading the facts in context. Now you might be saying, what's the big deal? If I tell you to go outside for 5 minutes and then come back in, and then you come back in and I said, okay, you were outside for 5 minutes. You go, yeah, Pete. I said, well, how many people were wearing hats? And you're like, I don't know. You didn't tell me to look for that. Right. If I had told you on the front end to go outside and look for the people wearing hats, you would know exactly what the answer is when you come back inside. Legalized cheating, folks. Look at the questions first. And a lot of times in a statement of cash flow, you know what they're going to ask you to do, right? Indirect method. So legalized cheating. Before I even read the facts, what am I doing? I'm writing down my formula, shorthand, add back my losses, subtract out my gains, subtract out my equity earnings in excess of cash received, my income statement adjustments, subtract my change in operating assets, add my change in operating liabilities, my balance sheet adjustment, and then whoop, there it is. There's my cash flow from operations, all right? Write your formulas down. You'll feel good as you read the facts. You can then process. When I see, oh yeah, operating, look at my change in operating assets, change in operating. Oh yeah, investing, that's the change in what? Non-current assets. Oh yeah, that's that LIP acronym. Am I making the loans, right? Those long-term investments, the PP&E, the financing, change in my own debt or equity. Man, you got all that information swimming in your head exam day. So you've got to now, set yourself up for success by making your cheat notes, and then you apply. Just make sure these notes come out of your head and not a tattoo on your leg or anything like that. All right. So let's do it. You ready? We got the name of this company. Here is the draft. Here's the unadjusted statement of cash flow. We know it's screwed up. Let's go through logically, line by line. Okay, my operating, indirect method, we start. Is this correct per the income statement? I don't know. Depreciation, what the hell happened to the depreciation? They got to add back the depreciation and most amortization. I don't see anything there. Well, we'll get that number on the income statement. What happened to that? A gain, what do we do with gains? We subtract it. Is that the right number? I don't know, but we're going to have to subtract the gain. An increase in inventory. Wait a second. Change in operating assets. What do we do? Well, when it's a change in the operating asset, we do the opposite. If it increased, this should be subtracted, not added. A decrease in accounts payable, change in operating liabilities, keep the sign. Decrease, they subtracted it, that looks okay. All right, investing, change in my non-current assets. They sold the building, that should be an inflow, it is. Payment for a plant they purchased, that should be an outflow. I don't know if that's the right number, but that's okay. Financing, change in my own debt and equity. Interest-bearing debt. Proceeds from a stock issuance, that should be an inflow. It looks like sale of an avail. What the hell is that doing over here? This is a change in a non-current asset. Wait a second. That belongs in investing. So this 135 should be an investing inflow. A cash dividend paid should be an outflow. Is that the right number? I don't know. Proceeds from a short-term bank loan. I don't care that it's short-term. It's still what? Interest-bearing debt. It's in the right place. That should be an inflow. It is. All right. All of these numbers, I don't know if these are right, but this should be per a comparative balance sheet. Last year's, this year's, and then my change. I don't know if these numbers are right. All righty. Are those numbers right? You take your change in cash plus your beginning, that equals your ending. I don't know if those numbers are right. I need a balance sheet. Okay, so I got a feel for what they did. I got an idea for some corrections that need to be made. But you see, like, it's a lot of information, man. It's a lot. Step by step. All right, here we go. Slow and steady wins the race. Here is my comparative balance sheet. The first thing I want to do is check out my cash. All righty. Year 2 is the current year. Year 1 is the prior year. Current year minus the prior year, there is your change, okay? There's your change in that activity. All right. Current cash, 840, prior year, 530, change in cash should be 310. I go back and cross-reference with the statement of cash flow. Okay, beginning cash should be 530, the ending cash should be 840. So the beginning cash should be 530, okay? What the hell is going on here? This is all screwed up. All righty, the change in cash should be 310. So that's screwed up. That's because these numbers are probably screwed up, but my change in cash better be 310. My beginning cash is okay. My ending cash needs to be 840. All righty, so obviously we got to fix things by fixing the change in cash. So there's your check figure. All right, let me go through these one at a time now. Accounts receivable. Ready? No change in accounts receivable. This is an operating asset. Inventory is an operating asset. Inventory went up by 80. So this should be what? A reduction. We know that. That should be reduced by 80. Okay, we've covered that already. What else do we got? Non-current assets. All right, folks, a lot of time on the non-current assets. You ready? The non-current assets, cash flow from investing. I love T accounts. I love them. All right, you don't have to memorize. It makes sense. There's two ways of dealing with PP&E, gross or net. Here's the gross amount. I'm going to first deal with the net, the gross cost minus the accumulated depreciation. That's $2,000,009. That should be my ending net book value. The $3,000,004 minus the $1,000,002, $2,000,002, that's my beginning net book value. I love T accounts. You ready? Let's bang it out. Your PP&E, your net book value, you got to know this code, folks. You've got a beginning balance. What's that beginning balance? $2,000,002. You've got an ending balance. What's the ending balance? $2,000,009. What makes it go up? Stuff you buy. That's a cash outflow investing. What makes net book value go down? Current year depreciation. What else makes it go down? The net book value of anything you've sold. Where do you get current year depreciation from? The income statement. current year depreciation is always per your income statement. So let me see, did they give me an income statement? Okay, so did they give me an income statement? So the next thing you're looking for is, hey, did they give me income statement information? I see my net income. Okay, I see long-term investments, cash dividends, stock, PP. All right, here we go. PP&E, yeah, you know me. All right, they tell me a building with an original cost of 600 and a carrying amount of 350. Stop right there. It immediately becomes information overload. So we've got an original cost of 600 minus your accumulated depreciation gets you your net book value. Okay, carrying value is synonymous with what? Net book value, 350. So folks, what's our accumulated depreciation gotta be? Our accumulated depreciation, well, we could back into that, right? 350, 455, accumulated depreciation, 250. All righty, selling price, 350, minus your net book value, 350, no gain or loss, right? No gain or loss. All right, so what I want to do is I now want to look at my PP&E account, the gross amounts. You've got a beginning balance, you've got an ending balance. What makes your PP&E gross go up? What you buy. What makes your PP&E gross go down? The net book value, excuse me, the cost of anything you sold, okay? The cost of anything you sold. The cost of anything you sold. All righty. It had an original cost of what amount? 600. Agreed? Give it information. All right, I go back to my balance sheet, my PP&E, my gross amounts. Beginning 3,000,004, ending 4,000,001. Beginning 3,000,004, drop your zeros, your ending was 4,000,001. Now, had we not bought anything, what would be my ending balance had I not bought anything? Well, if I didn't buy anything, the beginning cost, 3,000,004, minus what I sold, the cost of what I sold, 600. Well, if I didn't buy anything, my ending gross amount, ignoring depreciation, would have been 2,000,008. Well, obviously my ending balance is not 2,000,008. It's not. My actual ending balance for the gross amount, 4,000,001, minus the 2,000,008. Well, then I can infer the cost of what I bought must be how much? 1,000,003. I must have bought 1,000,003 worth of stuff. I must have bought 1,000,003 worth of stuff. Agreed? Okay, so we got another piece of the puzzle. Go back to your T account. What is the cost of the stuff that I bought that year? 1,000,003. So we have that piece of the puzzle. Agreed? And we have something else. The net book value of what I sold. That was given information. I go back to that given information. What was the net book value of what I sold? The net book value, the carrying value, the net book value was 350. Okay. Net book value is 350. Now I say to myself, okay, what must my current year depreciation be? What must my current year depreciation expense be? Well, if you take 2,000,002 and you add 1,000,003, what do we get? 3,500,000. Agreed? You get 3,500,000. Okay, as of right now, I only know one number, the net book value of what I sold. So the net book value of what I sold, I take that 3,000,005, I'm going to subtract out that 350, the net book value of what I sold. The net book value of what I sold, 350, what does that get me? 3,150,000, right? Had I not had any current year depreciation, if there were no current year depreciation, that would be your ending balance, right? That would be your ending balance. But that's not my ending balance. Well, what's your actual ending balance? My actual ending balance is 2,009,000. Well, why is the ending balance lower? Why is it only 2,000,009 and not 3,150,000? Because your current year depreciation must be what amount? 250. That's one way of finding your current year depreciation. Okay, that's one way. I'll show you another way in a second. Using your accumulated depreciation, you could find your current year depreciation as well. Okay, I'll show you that in a second. All right, but there's multiple ways. Now, when there's multiple ways, we're not learning multiple ways for the hell of it. We've got to know the various ways of backing into information, because I don't know how information will be given to you exam day. That's why you've got to make sure you understand the T account, because then you could back into any missing piece of the puzzle. Different questions, different missing pieces of the puzzle. All right, but we know our current year depreciation now. I got to add back 250,000 is my current year depreciation. We found another piece of the puzzle. Okay, I go back to my balance sheet. The next thing I'm looking for, my liabilities, accounts payable, operating, dividends payable. Now this is going to help me find dividends paid. Okay, that's going to help me find my dividends paid. So here we go. Here's my beginning dividends payable. Here's my ending dividends payable. So this is what I want to do. My beginning dividends payable, 240, plus the current year declared. That will get me the total due. And then that total is either paid or it's an ending dividends payable. What's ending dividends payable? 400. All righty. So I take a look at my statement of retained earnings. You ready? This information right here, statement of retained earnings. How do we do a statement of retained earnings? Your beginning retained earnings. What's the beginning amount? 2,775,000. Drop the zeros. Plus your current year profit. Now we know our current year profit. Okay, what's our current year profit? 790. Given information. Okay, we scanned that. We saw it. 2,775,000. Add your current year profit. Now look, if you have a loss, subtract it. Right? It's a profit, so we add it. So that gets me 3,565,000. Okay, now what's my ending retained earnings? My ending retained earning is 3,065,000. Well, why is that lower? We must have declared dividends. How much is the declared dividend? It must be how much? 500. 3,565,000 minus 3,065,000. Given information. We must have declared 500 because we know the way the pieces of the puzzle fit. All right, so I add the 500. We owe, the total due the stockholders is 740. So folks, if my ending dividend payable is 400,000 right here, then we must have paid how much? 340. We must have paid 340. Let me go back to their draft copy. Did they get that right? The dividends paid, yup, they got it right. 340 outflow. Okay. Accounts payable, let's see. Decreased by 5, beginning, the ending. So did they subtract that 5? Let's see. I go back to the prior slide. What did they do with the accounts payable? The accounts payable, yup, they decreased the 5. They did that. Okay. So no problem there. I keep going down. Short-term debt. Even though it's short term, it's what? A financing liability. Okay, they issued 325. Let's see, did they put the 325 in there? Yes, they did. They did that right. No problem there. Long-term debt, another financing liability. When you see the word debt, doesn't matter if it's short term or long term. No change, so no change. There should be no change, and there is none. All right, common stock. You ready? Let's see. Beginning balance 600. Ending balance 700, so that's a plus 100. Additional paid in capital, beginning balance 700, ending balance 820. So total change 220. Both of these should be financing inflow for a total of 220. They got a total of 220. They did it right. Okay, and we already know we got to move our available for sale. So again, we're just going down the line, finding the pieces of the puzzle. Okay, now long-term investments available for sale were sold for 135. Okay, now selling price minus your carrying value, gain or loss. So my selling price, 135. That should be an investing inflow. We know we have to fix that. What was the carrying value? Let's see. Let's go back to the balance sheet. What was the carrying value for that investment? Well, the change in our long-term investments, our change here was 100,000. So it's got to have a carrying value of 100,000. That is per your balance sheet. All righty. We have a gain of how much? 35,000. That's got to be an adjustment to net income. We got to subtract. Let's see if they did that correctly. Did they do the right thing and subtract the gain of 35,000 on their draft statement of cash flow? They did the right thing. Check that off. Okay. Cash dividends of 500,000 were declared, yet only how much was paid? How much did we say was paid? 340. We checked that number. Yup, dividends paid 340. They did that correct. So we're just going through our given information step by step. The issuance of the shares, the 10,000 shares times 22, that's a financing inflow. Double check, 220,000. We got it. We saw that 220,000. They did that correct. Okay. Let's see. Now the PP&E we took care of. All right. We found our current year depreciation, what have you. So now they ask us as part of our requirements, hey, fix things one at a time. So this would be part of what we need to do. So the draft statement of cash flow is what was done. How do we correct that? Well, we found the current year depreciation. We said, hey, that current year depreciation's got to be 250,000, and we add that back to net income. So the current year depreciation, the corrected amount, 250,000, and we got to add that back to our net income. So that's the first thing we have to correct, right? So we're going to have to add that back. Got it? All righty. So this is all part of that given information again. Now let me show you something else. You ready? We said the selling price was given information, 350. The net book value was given information. They called the carrying value, same thing, also 350. So gain or loss, 0, right? Gain or loss was 0. Original cost minus the accumulated depreciation is the way you get your net book value. Original cost, they tell us, was 600. What's the difference between 600 and 350? Our accumulated depreciation on what was sold, 250. Hey, we could look at a T account for accumulated depreciation. Accumulated depreciation is a contra asset. We remember, yeah, it's got a credit balance. So the right side makes it go up, the debit side makes it go down. Per my balance sheet, I go back to my balance sheet, I find my beginning and my ending accumulated depreciation. Beginning and ending, $1.2 million. So my beginning balance, $1.2 million. My ending balance, $1.2 million. What makes accumulated depreciation go down? The net book value of anything you sold. What was the net book value of what I sold? Oh yeah, 250. Wait a second. $1.2 million minus 250. My ending balance should be what amount? Well, if you take $1.2 million and you subtract that 250, what do you get? 950. $1.2 million. You know I can't do math in my head. Told you my IQ wasn't that high. This would be my ending balance. It's not. My actual ending balance is $1.2 million, not 950. What's that difference? 250. So folks, what makes accumulated depreciation go up? Current year depreciation expense, you debit, you credit accumulated depreciation. So folks, my current year depreciation has got to be what amount? 250. That's your current year depreciation. It's another way to back into that current year depreciation, because your ending balance would have been 950 if there were no current year depreciation, and we know that there is. All righty, so the actual ending balance, $1.2 million, not 950. Current year depreciation makes accumulated depreciation go up. $1.2 million plus the 250, $1.450 million minus the 250, yup, $1.2 million. All righty, so the corrected amount for depreciation expense, 250. We add that back, that gets added to our net income. All righty. And again, how did we find it? Different pieces of the puzzle. Accumulated depreciation goes up with credits, down. The net book value of what we sold, we backed into that. They told me it had a carrying value. It had a net book value, they told me, of 350. Then we can infer the accumulated depreciation on what was sold must have been 250. We backed into that 250. All righty. So $1.2 million minus 250, $1.2 million minus 250. Well, that would be 950. Obviously, our balance is not 950. It's actually $1.2 million. So my current year depreciation, 250. We have multiple ways of finding it. Okay, or net book value for PP&E, you could do that as well. Beginning balance plus what you buy, that's all on your debit side. That gets you your ending balance. What makes net book value of PP&E go down? Current year depreciation, as well as the net book value of anything you sold. So if you have those pieces of the puzzle, you've got two ways of finding your current year depreciation, as you've already seen. And again, multiple ways is not for the hell of it, because the method you use exam day, I don't know what they're going to give you. Okay, the gain on the sale of available for sale securities, that was okay. The selling price, given information, 135. The carrying value was 100. So the gain was, in fact, 35. So that is okay. No adjustment needed. All righty. So selling price, 135. Per the balance sheet, the carrying value of what was sold had to be 100. Okay, that was given information, we saw that. All righty, so one more time, where did we see that? The change in our investment account, 100. Long-term investments, right there. It went from $1.6 million down to $1.5 million, 100. So that's where we found that number. 135 minus 100, we got that piece. Okay, so that is correct. And if they want the journal entry, we know how to do the journal entry. You sell securities. Okay, cash inflow, investing. If it's listed as a non-current asset, all righty. Long-term investments, the carrying value, that non-current asset went down, cash went up, your plug figure, the difference between the two. That gain, we're going to subtract from net income, right? Makes net income go up, but not part of our core business. When we do our operating activities, indirect method, that gain gets subtracted from net income because it is non-operating, not part of our core business. The cash inflow goes cash flow investing, but the gain gets adjusted when we do our operating. The increase in inventory, we have a change in an operating asset. We subtract, we do the opposite. If it increases, this should have been, this is wrong. This should have been a negative. If it increases, you do the opposite, you subtract it. Okay, so that should have been subtracted. They screwed that up. We corrected that. Decrease in accounts payable. We add, keep the sign, the change in operating liability. Positive means direct relationship. If it's a decrease, you subtract it. That's okay. They did the right thing. All right, it went down, so they subtracted it. They did the right thing. All righty. Proceeds from the sale of the building, investing activities, your PP&E, your selling price. This should be a cash inflow investing. They had this as a cash inflow investing. They did the right thing. That's okay. No correction required. Okay, the building, original cost is $600,000. Carrying value of $350 was sold for $350. Cash in investing. So that's part of our LIP. Okay, you make a loan, you're the lender. You're on the lender side, the L for lender. Change in investments, PP&E, it's all part of our non-current assets. Proceeds from the sale of the building, they did the right thing. Cash inflow investing, that is correct. Payment for purchase PP&E. Now we backed into that. Net book value of PP&E. Beginning balance. That was $2.2 million per the balance sheet. The ending balance was $2.9 million. We know our current year depreciation. We know that is $250. We solved for that. The net book value of assets sold, we saw that was $350. So we backed into this $1.3 million. $2.2 million beginning balance minus $250 minus $350. Our ending balance would have been $1.6 million had we had no purchases. Had we had no purchases, our ending balance would have been $1.6 million if we didn't buy anything. But our actual ending was not $1.6 million. It was $2.9 million minus that $1.6 million. So then we can infer that we had purchases of how much? $1.3 million. So what we bought, $1.3 million. We should have $700,000 is wrong. The payment for the plant asset purchase, that should be $1.3 million outflow, investing outflow, $1.3 million. They had it as $700,000. Nope. That should be $1.3 million. That is the wrong number. All righty. Beautiful, beautiful. So the plant asset was purchased, $1.3 million. Investing outflow. And how did we get that? Our PP&E T account. Okay, our PP&E T account. Now, not for the hell of it, but we know we could have also solved for that by looking at the gross PP&E account. Our beginning balance, our ending balance, we're given information. The sale of the building, the original cost was $600,000. That was given information, right? So had we not bought anything, $3.4 million minus $600,000, our ending balance would have been $2.8 million had we not had any purchases. But we must have had purchases because our actual ending balance is $4.1 million. Same result, different format. We must have had $1.3 million in purchases. Same result, different format, using either net book value for PP&E or gross. All right, you've got to know both cold. You got to know both cold, okay? So you can solve for any missing piece of the puzzle. Whenever you have net book value of PP&E, you use the net book value of what you sold. If you're using the gross amount, then what you reduce the gross amount by is the original cost. That's it. Same result, different format. We are kicking ass, baby. Proceeds from the issuance of the stock. That is a financing inflow. Was the 220 correct? Yes, it was. Some of that was in stated capital. Some of that was an additional paid in capital, but the 220, we know that that is correct. They sold 10,000 shares at $22 a share. Yup, 220,000. Our own stock, financing inflow. When you sell your own stock, financing inflow. Okay, so the 220 was okay. That was correct, financing inflow. Proceeds from the sale of available for securities, available for sale, debt securities. That is the change in a non-current asset. This should have been, that's wrong. This should have been cash inflow investing, cash inflow investing. So that 135,000 should be investing inflow. That is the correction. Remember, with investments in other companies, preferred equity, common equity, or debt, if it's listed as a current asset, when you buy or sell it, operating. If it's listed as a non-current asset, when you buy or sell it, what category? Investing. Investing activity. When you see available for sale, fair value through OCI, or you see amortized cost, or what they call held to maturity. Absent any other information, the default rule, non-current asset investing. When you see trading security or available for sale or fair value through P&L, absent any other information, operating. But what controls is whether they're listing it as current or non-current. Absent that other information, the only thing, default rule, fair value through P&L, trading security available, trading security not available for sale, trading security held for trading, I meant to say. Sorry about that. Trading security held for trading, fair value through P&L. When they say nothing, presume the buy or sale is operating, okay? Any other security would be investing unless they tell you otherwise. All righty, so journal entry. You ready? We're on what side? We're on the sell side. So cash is going up. Non-current assets are going down. Inverse relationship. Investing inflow. Investing inflow. What's our plug figure? The gain. When we do statement of cash flow, operating activities, what do we do with gains? Gains get subtracted. That's an adjustment to net income. Why do we subtract that 35,000? Not part of our core business. Gains are kind of like revenue. It makes net income go up, but revenue is your core business, gains are not. Losses are kind of like expenses. Bad news makes your net income go down, but when you see the word loss, hey, that's not part of my core business. That's non-operating. Cash dividends paid, 340, that was correct. Remember, on the US GAAP, financing outflow, and it's got to be cash, and it has to have been paid. All right, so we saw that. All righty. So they tell me I declared 500. That was given information, although we found it. You can use a T account. Dividends payable, a liability. You got your beginning balance, ending balance. The current year declared makes it go up. So we owed our people how much? We owed our stockholders 740. Yet our ending balance, what we didn't pay is 400, so we could say, hey, then you must have paid how much? 340. They did the right thing. 340, no adjustment required. Financing outflow. Make sure it's a cash dividend, not stock, not property, not stock, not property. Okay, and make sure it's actually been paid, not just declared. And when you receive a dividend under US GAAP, when you're on the receiving side of a dividend, where's that go? Operating inflow, assuming it's a cash dividend that you received. All righty. I don't care if it's a short-term or long-term loan. When it's a loan, a bank loan, a note, debt, bond, debenture, mortgage, when we're the borrower, that's a financing inflow, even though it's short-term. Why? Because it's interest-bearing debt. They had that as a financing inflow. They did the right thing. Okay, no correction required. They did the right thing. So folks, here it is with all the corrected numbers. All right. So now you would have to probably cut and paste from those various entries line by line, logically go top down. Net income per our income statement. Depreciation we add back. The gain we subtract out. The increase in inventory, we do the opposite. We subtract. Decrease in accounts payable, we keep the sign. Cash provided by operating, 920. Okay, 920. How do we know this is the indirect method? Because we started with net income. All righty. Now, this is actually a good sign because the cash collected from operations is actually greater than the accrual basis net income. So you know what? That's pretty good. So I believe that's high quality of earnings because the actual cash received is greater than what they're showing me on the income statement. Proceeds from the sale of the building, change in non-current assets, yeah, inflow. Sale of available for sale, yep, investing inflow. We bought PP&E, outflow, 815. Okay, negative, good, that's good, that's negative, we're growing. What we buy was greater than what we sold. That's actually a good sign, right? We're growing, we have enough money from our core business so we could take surplus cash and make investments. When you're growing, value goes in what direction, value and growth are directly related. Cash flow from financing, proceeds from the sale of stock, we got that. Cash dividends paid, outflow, we got that. Proceeds from the loan, so that's a positive 205. Now we net that out. 920 minus 815 plus 205. Does that equal our change in cash? Yup, plus our beginning, ending. And we just officially kicked ass. Damn it, Keith, Megan, who's better than us?
Nobody.
Nobody.
There you go. All right, Quinn, let's go, baby. Where are you? All right.
I'm
gonna
right
help
there.
Quinn
Before we
out.
jump in, do you want to take a couple questions, Pete?
Oh, yeah. I'm sorry, Eddie. Yeah. Let's do the questions. Absolutely.
Okay, great. And I wanted to note to everyone on here, I know the system allows you to raise your hand. If you have any questions, just go ahead and put it into the chat and the team will answer it there. As for the questions, we've had a lot of questions just asking for some general tips on time management. Is there anything that you can share, words of wisdom?
Yeah, speed comes with confidence and mastery. So when you're initially practicing, focusing in on timing is counterproductive because you're rushing and you're not learning from the questions. I don't know what you're studying with, but UWorld spends a lot of time on their detailed explanatory answers so you can learn why the right answer is right and why the wrong answers are wrong. Do not sweat the time initially. As you get additional practice, the speed will naturally improve when you've mastered the concept, you know your formulas, and you're more confident, okay? We recommend a minimum of 3 practice exams that you do at least a week to 10 days before the actual exam, because nobody runs a marathon the day before the marathon. It would burn you out, right? The purpose of the practice exams, ironically, is not so much the content. You should have mastered the content. Granted, you get additional practice, but that's where you practice. Testlet 1, Testlet 2 should approximately be about 2 hours, right? Testlets 3, 4, and 5 should approximately be the last 3, your task-based simulations. But that all comes, why? By practicing that. That's why you got to take those practice exams in exam conditions so you're practicing your time allocation. And remember, a certain percentage of your multiple choice won't count towards your score. A task-based simulation, they're pre-test questions to help develop future exams. So look, when in doubt, move on. There's going to be stuff you don't know. That's okay. Just guess, and guess quickly. When you work multiple choice, you have on average, I don't know, a minute and a half, let's say. You work a question, math intensive, takes you 3 minutes, and you get a number that's not a choice, pick your favorite choice and move on. Don't work it a second time. Because then even if you get it correct, best case scenario, your body clock, now that you spend 6 minutes on a question, is going to tell you need to speed up. What would have been easy becomes difficult because you start making silly mistakes. So even if best case scenario, you spend a lot of time on that. You know what the worst case scenario is? You got it right and it don't count. You can't allow that to happen. So when in doubt, move on, man. Whether it's an individual multiple choice and the task-based simulations, when you open up the testlet, you might have 2 or 3 problems. Work those problems within that testlet in the order that's best for you. What you're strongest with, do first. What you're weakest at, do last, because you got to keep track of time within a testlet. So look, if you're going to rush and run out of time, let's rush and run out of time on your worst question that you probably weren't going to do that well in anyway. But this comes with practice and mastery. That's what I got, Mad. That's what I got for you.
I think that speed comes with confidence, and mastery is my new favorite line. Thank you.
Don't steal it. Don't steal it.
Oh, I am. I'm in marketing. Okay, so what is the effect of goodwill when preparing cash flow statements? Under the non-current assets, it was 0 last year, and there is goodwill of $1 million this year.
So anytime a non-current asset goes up, what is that? Investing. So whether it's goodwill, property, whatever it is, if it's a non-current asset and it increases, that's because you have, how does goodwill come about? You've got your purchase price, $800,000, yet the fair market value of the identifiable equity, which is your identifiable assets on or off the books, identifiable liabilities on or off the books. You get your fair market value of identifiable equity. Let's say you bought 100% of the company, but The fair market value of the identifiable equity is only 750. What the hell did you spend the extra 50 on? I don't know, but we can't call it I don't know. So what do we call it instead? Goodwill. Goodwill just went up. That is part of that purchase price. That is part of your investing outflow.
Oh, thank you.
got it.
I got a few people saying that they liked your headband and want to know, can they get one when they pass the exam?
Yeah, you know, I should start selling this, man. I got to tell you, they've been telling me for years, like, you crazy people like this stuff. I know I'm not an influencer. How do I be an influencer? Like, that's what I need to do. I need a podcast, but I'm afraid I say something crazy and get myself in trouble. The less I'm on, the better. I got a big mouth, as my father used to tell me. So, no, yeah. Oh, how do we get? Yeah, I'll send you one. I'll buy you a cup of coffee and I'll send you a headband. You'll get, no. You get the headband if you become an Elijah Watt Sells Award winner. Everybody who passes, I'm going to buy your coffee. You become an Elijah Watt Sells Award winner, you get one. I'll give you this one and I'll sign it and everything, man. It'll devalue and depreciate it, but I'll send it to you anyway. Let's go. What else we got?
Perfect. Okay, one more question before we move on. Would you consider that the UWorld questions to be more difficult than on the actual exam? Some providers highlight this as an advantage to their material.
What makes questions difficult sometimes is that they're oddball questions, trivial pursuit. In my opinion, a good test bank, 100% of the questions, 100% should highlight testable core items. There's really no way to simulate the trivial pursuit. In my opinion, those quote unquote hard questions are a waste of your valuable study time. You want to practice heavily tested core concepts, not minutia. So honestly, a good practice exam should be focusing in on on the core concepts. So look, I know there's a marketing to, our questions are harder and all that stuff. I think you could be doing people a disservice with that, just my opinion. I think our practice exams, we don't waste your time with a lot of definitions. We don't want to do that. Okay, but we want to certainly focus in on heavily tested and probably the more math intensive, but core concepts. No off the charts minutia that's going to, I don't want you spinning your wheels on nonsense. So we're not going to do that. I disagree with that approach. Teach his own, but that's why I'm at UWorld, baby. This is the place to be.
Thanks so much, Pete. Quinn, you want to take it away?
Yeah, Pete, thank you so much. What a great session. Thanks, guys, behind the scenes. Questions were awesome. Just great to see the activity level. Lots of interest in the program. And if you like what Pete did today, if you're interested in having him or one of our other instructors actually come to your firm virtually or in the actual CPA review program, we're going to share some details on how. And anyway, you got a taste of what it's all about. We've got national credibility and instructors led by Peter and Roger, but backfilled with a cadre of folks that have all public accounting experience. So if you want to learn from people that actually have filed the forms and done the work and are in firms just like you, that's what we've got. So joined by Keith and Megan today, with Matt and I hanging in on the backside. These guys are super credentialed, big brains, and they're reflective of who is working in our practices today and in our firms. So big team behind the market leaders here for us, and glad and thankful for each and every one of them. New exam, a lot of questions about this. What exactly am I going to be assessed on? Well, at UWorld, we make it very clear for you. We've literally taken, here you're looking at the actual AICPA blueprints, and we delineated these as representative tasks. They're not only showing us the key thing that we're going to, skill that we're going to be responsible for, but the level of that skill. So as highlighted, it could be remembering and understanding. That's going to be a multiple choice question. Could be an application or an analysis question. Could be a multiple choice or possibly task-based simulation. So as you go through the UWorld program, you're going to see complete transparency to what's on the exam and the specific skill level and these representative tasks. So you'll see them delineated from every single lecture. So if Pete kicks off the FAR section, the first 30 seconds, he's welcoming you to the system and he's talking about what's going to be on this exam. Check out the representative task. We go to the next slide. This is exactly what it looks like. So here it is in the ebook. You'll see the pedagogical check marks. What do they say? Representative tasks. But look down more specifically, and the parentheses, you see the analysis, and that tells us an application, that's the exact skill that we're going to be required. So that's going to be required of us on the exam. And even better, when you get into the UWorld QBank, guess what you see at the end of every question? It's actually going to show you those representative tasks. But here's one of the hallmark features. We've got basically our question here. We're now in the Prometric interface. We're very, very big about practicing how you're going to be assessed. So we're got you in the interface, but we're also giving you the advantage of seeing people that have used the system, how they're responding. And this can be really helpful, especially in the case where you didn't get it right. Well, are you way wrong? You know, like a 4% wrong, or are you maybe closer to the majority? So anyway, right, 4 makes us very sad, 62 makes us very happy, but we know that there's points of calibration. And like Pete said, one of the best test taking strategies, read that question, read it twice or 3 times, sometimes read it backwards to make sure that you are clearly getting the action item that you're being asked to do before you start preemptively working in order of operations. The key thing that we're known for, really good quality answer explanations. These follow and are really helpful when we're challenged and we didn't get the answer right. We start off with an illustration, an explanation that usually includes a visual, and then a really clear, concise, pithy delineation of why every other answer is incorrect. And ladies and gentlemen, when you're making the heavy lift of your study time, you want something that is worthy of your time and is going to show you what the gaps are in learning, and then also give you a key takeaway of where the concept relates back, as well as an additional learning activity. So in the case that you were going to get it wrong, you've got links right back to the lecture. You have a chance to develop a note card, put something in your notebook, or a flashcard right on the fly. Thank you, Pete. Let's go to the next one. All right, where does this all go and why is it so important? Very unique secret to the UWorld sauce is delineated in something called the SMART path. So welcome to the SMART path. What is it and why is it going to help you pass the exam? Well, it is detailing for you those sections of the previous exams where UWorld users reported that they passed on their first time. And if you look closely on these progress bars, you'll see these green little check marks and these little kind of targets. And those targets delineate exactly where you need to be on a performance level as well as number of exercises. This is not the 1950s model of skill and drill. Have to watch every single lecture, have to do every single exam. This is basically allowing you to see where people who, just like you, passed the exam the first time and the average performance they had and the average number of questions they took. So once you hit mastery, you get to move on. You don't have to complete the whole thing. More importantly, you get to see exactly those areas that you've got under control and those places where you need more time. So a lot of questions about time management. This is one of the best and friendliest time management tools you could have. Shows you the areas of particular strength and those of weakness. You get to see them over there on the status. Ladies and gentlemen, when those turn to green, you are test ready and you are ready to go. All right, Pete's excited to show you. He's going here. Green means go, right? He's jumping all over the place. He's got that second cup of coffee today. He wants to show you the dynamic study planner. This is terrific, okay? This literally is going to show you, in this case, I think we're talking about FAR. You could see on the right, there's a total of 240 study hours through the whole customized course. But you get to break those study times down based upon when you want to be exam ready. In this case, it says March 17th. I like that, right before St. Patrick's Day. And then, yep, and you can also do a fast track versus the full comprehensive. So fast track would be great if you were probably in a retest situation, but we would always recommend start off with the comprehensive. And more importantly, this is a great way for you to have a tool that's going to literally give you a day by day, a week by week schedule based upon your schedule. How many hours can you give us? So if you're talking about basically a regular work week, maybe you can go Sunday and Saturday kind of hard. But I know, Pete, you've got some comments to say here. This is kind of like going to the gym. You want to hit it every day. If you can do 1 or 2 hours during the week, that's great during this busy time of year. but more importantly, consistency is going to win the day. It's going to build that confidence, and it's going to get you to exam readiness. Now, one thing that's great about this, go back for just a sec. Look, we all know what season we're in. You can adjust this on the fly. So if Pete says, look, I'm in the middle of busy season, I'm going to have to put this on hold for a little bit. I got to take down my Monday through Friday, and I can just work on the weekends on my plan. You can actually do that. It's going to recalibrate on the fly. You literally have a daily path that's going to show you. So if you're working with your mentor at work and you're trying to explain where you are, great way just to show them in your snapshot. More importantly, it's a way for you to just manage this whole process in chunks that are attainable and set to your schedule. What does that say? No fun for you?
No fun for you.
Not for a little bit, but it's going to be worth it afterwards.
That's right. What is your, you want to find a regression model for your probability of passing? Check this out. You could now do your probability of passing. You can regress that against your happiness. And what is the relationship? It's inverse. The more time you're putting in studying, you are miserable, but your probability of passing goes way up. If you're happy you're not studying enough, that means you're going to do what? You're going to fail. All righty. So make the commitment, do it once, do it right, and then you never have to do it again. And for those of you out there who are not yet working full time, do it now. Talk to people who are working full time and trying to study simultaneously. That's when it becomes so challenging. When you're getting those extra 30 credit hours, talk to us. We'll help you pick the right electives, and then you can use those electives and study with us. Your grades will be better in school because you're reviewing that same content with us, and you'll be exam ready so that you can knock out hopefully all 4 parts, but a minimum of 2 or 3 before you start working full time.
There's another commitment we want too. If you like this type of learning, if you like the personality in conjunction with this great order of operations, working problems, we do it really well. We've got a great comprehensive package for you. And listen, if you're at a firm and you like this and you're using New World, or you came over from Wiley and you're interested in being an ambassador, my information's coming up next. Please reach out. We'd love to commit to you and give you a preview of the great features that are coming, including live sessions, and additional cram courses and other features that are coming. So look at that. What you want to explain that? I think we can read that.
Yeah, no, just the whole team. You know, it's the pass rate. I mean, you know, and again, our pass rate doesn't say, hey, you have to do every single lecture. You got to work every single question. No. Why would you do that? If you just got an A in state and local governmental accounting, go right to the multiple choice. We don't force you to watch every lecture first. We don't force you to work every single question. Everything is on a sliding scale, like Quinn showed you, dependent upon your confidence level, whether you're an A student, a C student, you just graduated, you're out of school 10 years, you can customize depending upon your own personal strengths and weaknesses. And folks, that's the name of the game, not only passing, but if I could pass in 80 hours versus 180 hours, why would I want to put in that extra time? So we don't force you to do those things. We give you every possible tool in the arsenal to make yourself ready. But you know what it is, man. It's just like in college. You ask your friends, who was the professor? The professor. It's like rooting for your favorite team, right? Like, you know, Yankees ain't what the Yankees used to be when they had Derek Jeter and Bernie Williams and them guys. You know what? It's not the uniform. It's the people in the uniform. Ask your colleagues, not only the course they took, but who were the instructor or instructors they really liked. That's what you need to do, just like in college. Whether it's Roger, the folks at UWorld, these are people that have huge followings because they were beloved doing what they do. And there's nobody here pretending because they have the letters. Not everyone here has worked in public accounting. This is what they've committed their lives to. So you're not going to be taught audit by somebody who's never worked in public accounting, who's never done an audit. You're not going to be taught tax by somebody who's never done a tax return. That's ludicrous and that's unfair to you. These are committed professionals who devoted their life not only to accounting and the practice of accounting, but teaching it. They're excited about what they do. We want to see you pass. Look, UWorld's looking to cap. We want to be #1 in this industry, and we're going to be. But by getting you through the exam, by helping you, it helps us. The word of mouth, the social media, this is what grows a business today. I mean, so really, we're hoping you looked at this today and say, look, don't tell me what you do. Show me what you do. We want to earn your business. Damn
Oh,
it.
and here's where you can do it. If you want to sign up or get some information, more additional, next slide, please. We've got it here for you. So go ahead, click this link if you'd like more information. We will set your firm up with a direct bill partnership. We've got about 200 firms are already in that boat, many that are represented here today already. So great to see our friends there. But if you're looking for that relationship to get started, or you just want to set up with a purchase code and a discount code now, click on this QR code. I'd be happy to help you.
And a better course at a better price. It's in your firm's best interest to give you these opportunities and these options. We want you to see our course side by side with anyone else you're considering. Your firm should allow you to choose. So please take advantage of this. We would love for you to help us out.
All right. So if you want to try now, hit the left. If you'd like to buy now, click on the right. Get those phones out, get those QR codes up. And if you're interested in being an ambassador for UWorld in your university or your firm, please feel free to reach out to me as well. You can find me as Quinn Perkson on LinkedIn. Please follow us, Peter Olinto, and UWorld Accounting. If you're going to want to join us for the next boot camp or lecture, we're excited to see you. We wish you the best on your CPA journey. Thank you very much.
Peter, we have another question.
Yep.
Can you answer?
Before I take that question, before I forget, I'm sorry, Mad.
Yeah.
We will come in-house at your firm. We've done this at EY, Deloitte. I'm in New Jersey, but I travel all over the country. If you're in LA, Chicago, Atlanta, wherever you, Florida, preferably in February, we'd love to come to your office and earn that business free of charge, no strings attached, like nothing. We just say, hey, we think we're better. We want to show your firm. We want the decision makers to see that. So I know it's busy season, but when that's done, let us know. We will come in free of charge. You pick the lecture, we'll come in and deliver it. Mad, go ahead. Sorry.
Oh, it's Megan. I was just interrupting
Megan,
and asking you questions on the fly. This says, to Peter, I invested in that course that you don't remember anymore. Do you think it's a good idea to convert to the UWorld course?
Oh, man, you want to get me legally in trouble. Here's what I'm going to tell you. It's your future. You know, I'm a big fan of Roger, and I'll tell you part of the reason I made the switch here is because Roger and I have very similar styles, which is very much appreciated at UWorld. Our zany nature, you know, this is not, you know, we're not doing brain surgery here. There's, we like to have fun with it, but we want you to learn funny acronyms. Nobody's editing my stuff and telling me I can't say this, can't say that, because for whatever insane reason. Roger is like myself. He's the COO of the accounting, the CPA program. We love it because we joke around. We have a great time. We want you to be a part of it. But can I say, all I could say is I want you to make the right decision for you. Sincerely, whatever that other course is or any course, watch not only myself, but Roger, Megan, Keith, the list goes down. Amber, we got phenomenal lectures. Jesse and I mean, you're talking about people who do this for a living. Watch it side by side. Let that guide you. And most importantly, we don't want you to pay twice. So talk to Quinn. If you're at a firm that's already paid for something else, we're going to work that out for you because we want you to have done them and to us, because then you could speak intelligently about the differences in quality, what works better. So even if your firm is paid, call Quinn. We will make it happen with your firm. We're working all kinds of deals because this is the way we're going to build our product. But I want what's best for you. And whatever is best for you is best for us. Okay, so put it side by side and let that guide you.
Thanks so much, Pete. I think that's a really good spot to end. We had a few questions coming in as Quinn was giving the updates on the course, and I think you really covered it well, Quinn. So thanks so much to everyone, the collective team, for making today happen. And Pete, you're talking about being miserable while studying, but with all the people we have behind here, I don't think that's true. You're this type of energy you'll see throughout the entire program.
Yeah, we got some crazy people that talk about missing studying for the exam. So if that's the case, I hope your firm has a good health plan so you can get some psychological help. But yes, we actually have people that enjoy this. So yeah, and then you could take CPA and go for the CFA, whatever you want to do. CMA, we got it all. So keep learning. Get those letters. The more letters you have, the more leverage.
That's right. The alphabet soup.
Well, I have to thank my teammates here. I really do. You know, doing Saturdays, and these are folks who are on salary and they're volunteering their time to be with me here today. I can't thank you enough, Mad, Quinn, Keith, Megan, I mean, the best of the best. And I got to tell you, you want to talk about nice people to work with. So yeah, it's just a great experience. Thank you, UWorld, for having me. I'm so blessed. And I want to wish you all the very best. I appreciate your time and attention today. I hope you got something out of this. And we hope to visit you at your firm in person or via online.
Thank you all. Enjoy the rest of your weekend.
You guys.